Good afternoon, traders. This is Trader Tim from eMiniMind, and I'm doing a market analysis video. Today is the 15th of March, 2021. I wanted to also mention that tomorrow, Tuesday, we will be doing, actually, I won't be doing a live trading session in the morning. We've moved that to Thursday because of the Fed meeting announcement on Wednesday. In typical fashion, Tuesday before the Fed meeting is usually pretty slow. So you have better opportunities kind of the Thursday after that Fed meeting going forward for the next 4 to 5 weeks. Things are usually pretty technical and clean. So we also have rollover or expiration happening this Friday in the futures market. So that means we've got both contracts trading this week, March and June. June's going to have more volume. That's now the front month. So you want to make sure that you're trading on that June contract. If you're using, a platform like Toss, when you type in \ES, it just brings up the June contract right now as the front month. But if you have to pull up some sort of trade ladder, make sure you're selecting that June contract so that your charts match up. This week, the four expiration weeks for futures tend to be, so they can be a little bit wonky because you've got traders, participating in both contracts, so the volume can be diminished a little bit. Then you add on top of that a Fed meeting happening. Be extremely careful this week. I will be treading very lightly. Didn't make any trades today. Likely to not make any trades until Thursday. And I know it can be enticing to want to always be doing something, but the less you trade, the less risk you're taking on. So if you're going to be, actively trading on any given day, just make sure that there are opportunities present, and you're not just sort of twiddling your thumbs trying to make something happen when there's nothing there. I mean, if you figure there's 52 weeks in the year, I mean, even if you only actively traded 30 of them, I mean, that's a lot of opportunity. But if you really mess it up on 5 or 10 of those weeks, or even just have 2 or 3 bad weeks where you just completely go off the rails and have some massive losses, well, those are going to eat up any gains that you have. So the more the longer I've been doing this, the less I tend to be quite as active, and the longer I'm able to hang on to my winners just by nature of experience and being able to sit in trades longer, being more patient and less influenced by emotion, if you will. But yeah, even if you only traded 30 of the 52 weeks of the year, I mean that's plenty of time to bag some really nice trades. So if you either strategically take time off during this type of a week or a few days. Maybe you take Monday, Tuesday, Wednesday off this week just because of the events that are going on. It sort of builds in some mental refresh time into your trading as well. So I wanted to start with the weekly chart here on the ES. You can see the extension high to high that we've been sitting in for the last 2 weeks now, and then the uptrend line that I also have on the chart. If I zoom down to the daily chart, sitting up at up near highs the last couple of days, Friday, and then so far today, a couple hours left before we close. Just looking like a nice bull flag. I like the overlap that I'm seeing in the candles from the prior day. So if we go back a little bit further, see how these gap ups were met with no overlap? Like we gapped up in price and then we never traded back at the prior day's levels. And then here we had nice overlap, decent overlap, and then gap up, didn't quite fill that gap, gap up, didn't trade back into those levels. So here we've got a little bit more overlapping of the bars, and that gives opportunity for shorts to drive things lower. And when we can't, when we reverse, or like we saw today, um, you know, sell off intraday and then rally either into the close or in the afternoon, that shakes out a lot of active shorts. So a much healthier market when we get some overlap versus just gap, 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 and all of this unfilled space below us. When you start to come back and fill those gaps, they can really start to fill quickly. So let's drill down to, we'll go to the 15-minute chart. You can kind of see an uptrend here by the heavily traded periods of the day. Um, Pretty nice uptrend. And then if you look at the last 3 days, really just a triangle. And we remember bull flag on the daily chart. So triangle being here we have a high, the low that kind of initiated the breakout, and then a pullback to a higher low as it relates to the prior one. This pullback is a lower high as it relates to the prior one. Here we then have a higher low, and then we're kind of open-ended at this point. If you wanted to draw the trend line like this, you could say we have broken the triangle and starting to move higher through the apex. But what I like to do is just use the most recent swing high and swing low as the break point. So this is where 39.25 or a 39.13. Those are the 2 points that I would look at for, if we break those levels, now we have a break, and then what we can do is project from, I like to take the widest point of the triangle, so we'll call it a 95 up to we'll just call it a 55. So 60 points. And then if you tack that on from the apex, 30 up 60 points brings you up to 39.90. We'll just round up to an even 4,000. Just getting a ballpark of a projection, that puts us at a 4,000 in the ES. If we go back to the daily chart, what do you know? If we pull back and look at the extension target, not too much further beyond that 4,000 level. The extension target is 4,032. So, given that our average daily ranges, we're talking around 30 points, a margin of, plus or minus 30. That's right in the wheelhouse. So looking for us to reach our target if we can come up and break this bull flag this week. A little bit concerned going into Thursday. When Jerome Powell speaks, we tend to see some fear coming in, and those days where we have the gap down and then the big selling. The last handful of Fed meetings, thinking back to this summer, and then there was one time this fall we sold off. It just it poses a risk anytime you're coming out of those Fed meetings. So I haven't decided if I'm going to put on a hedge on Wednesday afternoon at the close. If the NASDAQ can break above the 61.8, we'll go to the NDX. If we can break up above the 61.8 of the short before Wednesday, and not just stop, right here, if we can convincingly break above it, I would be super hesitant to put on a short hedge there if we break the 61.8. But if we stay underneath this 50%, we could easily just come back down to the 50% long and then make a double bottom and go higher. So that gives us enough room to capitalize on this move lower. If we're talking about buying puts on the Qs, which is what I would typically do, Q or SPY. In this case, since we're talking about the bearishness in the NASDAQ, I would be buying the Qs. So I had if we do like 317 and write it down to 300, I'd be more than happy with that. So we'll see what the next couple days do, and if we just kind of sit here, I may put a small hedge on just in case, and if things open up bullish on Thursday, then I can just close out and not have really any loss to write off. But if we were to get a bigger sell-off and come back down to the 50% long, then you have that hedge in place to protect yourself. So be a little bit cautious this week, a little extra cautious just because of things can be a little bit messy with both contracts trading. And then Wednesday, I typically wouldn't trade at all on Wednesday if it's a Fed meeting announcement. So you add on the rollover week or the expiration week. And definitely will be taking Wednesday morning off as well. So if you have questions, drop them in the comments below, and then you can tune into the live trading session on Thursday this week over at eminimind.com/VIP. Thanks, and have a great week.